We are now moving to part F of the paper 2 SAICA IAC exam. The question requires us to calculate annual effective cost on the new loan from the bank finance Ltd. So this is basically just a question that requires calculation, and then we are asked that we must ignore the taxation. So we are to ignore the taxation. So when we're calculating the the effective interest rates, you do not have to worry about any matters that relate to taxation. So we're going to do the same thing. We're going to go back to the scenario and see which part of our scenario had the information that relates to Bank Finance Ltd. So it was section 3 relating to debt refinancing. So that's where we're going to get the information that we'll need to analyze our scenario. So if we go down, it starts from here. So it starts from here rather, not here. It starts from this paragraph. So while they said the director said they aren't suggesting that we go with right issue at the moment, they said they will revisit during the following year to see if going for right issue will not assist in recapitalizing the balance sheet of the company. They then suggested that the best option is that we go with a new loan. We went on the market to check whether we were able to get a loan. Unfortunately, only one bank that was willing to refinance us. So what is the reason for that? It's because we are struggling financially and we are highly geared. So some banks, they're afraid that they might not get their money back. It is for that reason that only one bank was willing to refinance us. And the name of the bank is called Bank Finance Ltd. So Bank Finance was willing to finance us, and they gave us the following term for the loan they are willing to refinance us. It's 4.3 billion. The principal amount is 4.3 billion. We know 4.3 billion is the amount that we need to repay back the loans that are due in September. So that means that the total amount they're going to give us will be sufficient for us to cover the full amount of loan that are outstanding sooner. They then said they will give us a nominal interest rate of 19%. This is very high considering that our current loans are sitting at 10.75%. However, it is expected because we are now highly geared as compared to years ago when we received the first bulk of loans or the previous bulk of loans. Finance Ltd, they have to charge us higher interest rates for the risk they are taking to provide us a loan while we are highly geared. So that is why the interest rate is way higher than where it was or where it currently is with the other loans. Saying the loan advance date will be 1 July 2025. The term will be 3 years, and we need to pay an upfront issuance cost of 3% of this amount. The interest on the loan will be calculated and paid quarterly in arrears. So what does that mean? It means that the interest rate will be calculated and paid 4 times a year because we have 4 quarters in the year. And the principal amount will be paid in three equal annual installments. So the principal will be paid over the term 3 times every year. However, the interest will be paid 4 times a year. That means for the duration of the loan, it will be paid 12 times. The first payment for the principal will be 20 June 2026. Then French card is to pay upfront issuance issuance cost on the loan value on the loan dates, on the loan advance date. It believe it's gonna be on this date. And we're told this is calculated on the principal amount received, and we know it's gonna be 4.3 billion because we need our French cards need the total amount. So now we understand and we know the information that we have which relates to the suggested solution that we are doing. We are now going to go back to our suggested solution and then look at the answer and analyze it. So the nominal interest rate we're given, it's 19%. It's the one that we're saying it's very high considering that our current loans are sitting at 11.75%. Now we're going to need to calculate the effective annual interest rate. That is the rate that will be charged on these loans. How are we going to get it? We're going to use the formula, right? So what we're going to say, we know that we have 4. So we know that for interest, we are going to pay 4 times a year. So now how are we going to get this 20.4? The formula that we're going to use, it will be 1 plus I over n square root of n minus 1. So our I will be 19. Our n as a denominator will be 4. And then the square root will be 4. Then minus 1. That will give us 20.4%. Alternatively, you can look at this formula which says 1 plus I. In our case, it's going to be 19 over n. In our case, is going to be 4, which is the number of times per year we're going to pay interest. It's quarterly, and we know if it's quarterly, we have 4 quarters per year. Then the n will be 4, and then the square root will be 4, then we minus 1 times 100. That will give us 20.4%. Now we then move to upfront receipt. We know that we're going to receive 4.3 billion because the outstanding loan that are due in September, they require 4.3 billion. We are told that on the date of issuance, we will have to pay an issuance cost or an upfront cost at 3% of the total upfront receipt. So if you say 4.3 times 3%, you get 129. It is minus 129 because that will be a cost to us. Now you need to calculate the interest. Now, how do you go about calculating the interest paid? You're going to say 4.3 times 20.40. Then you get 877. So that is an effective interest rate for the full year. And that it has taken into consideration that it is paid quarterly. That is why we had to get the effective interest rate, because the interest rate is paid quarterly and we're going to calculate for all the quarters per year. Then now you know that for the first year, it will be before the capital payment is made. Therefore, the full amount will be used to calculate the interest rate. It will be this amount, which was upfront amount received, times 20.40, which is the effective interest rate. Then we get minus 887. It is minus because it's an outflow. So this will be an outflow for 2025. Then for 2026 financial year, we would have paid the first principal repayment amount. How we get this 1433? It is this amount of 4.33, which was upfront cost, then we divide by 3. Why are we dividing by 3? Because we are told that they will make an annual payment for the duration of the loan. And we know the duration of the loan, it is 3 years. So the second year, we're taking the full upfront cost. we minus it by the annual repayment, and then we times by the effective annual interest rate, which we've already calculated. And you can see here the interest rate is now reduced. The interest expense is now reducing. Why is it reducing? Because there is a capital repayment that has been done already. Then when we move to year 3, which is the last year, but this last year, it is before we pay the last repayment, but it's after the second capital repayment. So what we're going to do now, we know the balance now is 2967. We're going to bring down 2967 and we subtract the second year annual repayment of capital, which is similar to this amount of 1433, which is basically 433300 divided by 3, which is 3 years, and then we multiply by the effective interest rate again. As you see here, it further reduces, the interest expense is further reducing. And the reason it's reducing is because of merely the repayment that is taking place. Now we're going to then consider the capital repayment. How we get to capital repayment, I've said already, it's 4,300 billion divided by 3. We were told that the payment will be made annually over the duration of the loan. Then for 2020, end of 25, 26, and 27, we're going to have the same amount, which is reducing this capital repay, the advance or the loan advance that we received. And then now we then need to calculate the net of each period. If we look at year 0, we're going to have a net because that's the year, a positive net amount, because that's the year we receive the advance or we receive the loan from the bank finance. Then we have 4171. And then in 2025, there will be no capital inflow. However, we need to pay for principal and the interest. Now the total is minus 2310. And then the following year, it's the same thing. We will not have any cash inflow, but we'll have outflow for the interest as well as the capital. And the total comes to 2018. And then the last year, we're going to have the same thing, which is the interest minus the capital repayment, and they have 1726. Now, we have to calculate internal rate of return because that is the amount that we need to determine. How do we determine it? We're going to have to use the formula. The formula that we're going to use, it says the annual effective rate, which is this one that we already calculated. In our case, it's going to be 20.4. Then we're going to plus, open the bracket, and then in our numerator, we're going to put our positive NPV. In this case, it's going to be 4171. And then once we're done with that, we're going to say over. And then in our numerator, we put the positive NPV, which is the same amount, which is 4171 minus the negative NPV. And the total that you're going to get is 22.47%. So basically, to calculate the IRR, then that's how we're going to work the number. And then I already gave you the formula as well to calculate the effective annual interest rate. So that's how then we get to the end of this part, which is part F. Thank you so much for listening to this far. I really appreciate that. Can you please like, subscribe, and share my channel? My YouTube channel is Economics 199, as well as my TikTok channel. It's the same, Economics 199. Enjoy the rest of your day and all the best for your upcoming exam. Bye.